While the mainstream media is completely consumed by political theater, a quiet, seismic disruption has just been hard-coded into the American financial system. If you are operating your household or your investment portfolio under the same rules you used even 12 months ago, you are actively suffering from silent wealth erosion. The implementation of the 2025 reconciliation legislation, legally designated as the One Big Beautiful Bill Act, has fundamentally altered the cash flow mechanics of every middle-class household, pre-retiree, and wealth builder in this country. The game has changed, the tax brackets are locked, the credits have shifted, and the structural inflation drag is accelerating. If you do not adjust your cash flow architecture immediately, your capital efficiency is about to collapse. Most people are taught how to grind and earn money, but they are never taught how to structurally engineer it. Traditional personal finance content will tell you to cut back on groceries or build a generic budget. That advice is entirely useless in the current macroeconomic climate. Today, we are going to look at the hard data from the IRS, the Federal Reserve, and the Bureau of Economic Analysis. We are going to unpack the exact mathematical formula of the 2026 tax code adjustments. Look at the staggering real-world impact of the new $40,000 state and local tax deduction cap, and expose the massive policy-driven capital expenditure surge that is keeping inflation stubbornly high. By the end of this video, you will have a precise, systemic action plan to protect your capital preservation systems and accelerate your compounding. Before we look at the raw numbers, I need to know who I am speaking to so we can tailor this data layout. Go to the comments section right now, type in your current age and your primary financial or net worth goal over the next 5 years. Let's establish a baseline for your wealth systems analysis. To understand how severely these code updates affect you, you have to look at the contrast between two completely different financial strategies. Let's look at Mark. Mark is 55, makes a combined $250,000 with his spouse, and follows conventional financial wisdom. He takes the standard deduction, leaves his money sitting in traditional retirement structures, and assumes that because his income is high, his wealth is safe. Under the new 2026 updates, Mark is experiencing massive cash flow leakage. He completely missed the expiration of the clean energy tax incentives. His portfolio is taking a direct hit from an unexpected alternative minimum tax threshold adjustment, and his cash is sitting idle, suffering a severe purchasing power penalty due to an elevated 3.5% headline PCE inflation rate. Now look at Sarah. Same age, same income, same asset baseline, but Sarah treats her household like a sovereign wealth fund. She immediately re-architected her tax strategy when the One Big Beautiful Bill Act passed. She realized that the state and local tax, or SALT deduction cap, was lifted from $10,000 to $40,000 for married couples filing jointly. She structurally shifted her itemized deductions, maximized the newly expanded Section 179 business expensing limits through a side consultancy structure, and recalibrated her asset allocation to capture the policy-driven corporate capital expenditure surge. Mark is experiencing systemic wealth erosion. Sarah is experiencing compounding acceleration. Same inputs, entirely different systems. Let's dismantle the math. The One Big Beautiful Bill Act did not just extend the 2017 Tax Cuts and Jobs Act, it made the structural core of it permanent. The 7 individual income tax brackets are permanently set at 10, 12, 22, 24, 32, 35, and 37%. For the 2026 tax year, the IRS inflation adjustments have locked the standard deduction at $16,100 for single filers and $32,200 for married couples filing jointly. This elevates the baseline non-taxable cash flow floor for everyone. Meanwhile, the state and local tax deduction cap has been raised from a strict $10,000 up to $40,000, featuring phase-outs at $500,000 of modified adjusted gross income. This is a massive tax mitigation window for high-tax state residents. Furthermore, pre-retirees and retirees over the age of 65 gain a specialized $6,000 senior deduction bonus, offering significant cash flow preservation if joint income stays below $150,000. But it's not all cuts. Clean energy credits under Section 30D and 25E have permanently expired, introducing capital inefficiency for anyone holding legacy clean tech assets. On the business side, Section 179 corporate capital expenditure limits have expanded to $2,560,000. The Treasury Department's recent report to the Treasury Borrowing Advisory Committee confirms that business fixed investment in real equipment quadrupled in the first quarter of 2026, rising at an annualized rate of 17.2%. While this pro-growth policy drives corporate productivity, it creates a massive structural challenge for you. Headline PCE inflation has ticked up to 3.5%. This is substantially higher than the Federal Reserve's long-term 2% target. If your money is sitting in low-yield vehicles, you are actively losing capital to the inflation drag. Think about what this means for your cash flow architecture. If you are over the age of 65, you now have access to a specialized $6,000 senior deduction layered directly on top of your standard deduction, provided your joint income is below $150,000. If you fail to claim this, you are leaving thousands of dollars of pure liquidity on the table for the federal government to absorb. Conversely, look at what happened to the alternative minimum tax, or AMT. The exemption levels have been aggressively indexed to $88,100 for individuals and $137,300 for married couples. But the phase-out mechanisms trigger aggressively at 25 cents on the dollar once your income crosses $500,000 for singles or $1 million for joint filers. This creates a highly dangerous stealth tax trap for small business owners and dual-income households who do not structure their pass-through entities correctly under the preserved qualified business income frameworks. Your biggest financial risk right now is capital inefficiency. With energy goods and services inflation spiking at 12.5% on a 12-month basis through the early part of this year, your cost of living is structurally transforming. You cannot budget your way out of a macroeconomic shift of this magnitude. You have to engineer your way out. Here is the step-by-step structural blueprint you must execute immediately to insulate your wealth and optimize your cash flow against these policy realities. Step 1. Execute a SALT deduction audit. Analyze your property taxes and state income tax liabilities. If your combined state and local taxes exceed $10,000, you can no longer default to the standard deduction blindly. With the cap raised to $40,000 for married couples, coordinate with your financial professionals to run an itemization simulation. If your modified adjusted gross income is under $500,000, this single adjustment can unlock a massive, immediate liquidity event. Step 2. Restructure pass-through entities via Section 179. If you operate a side consultancy, 1099 independent contractor system, or small business, leverage the permanently stabilized qualified business income deduction and the newly expanded $2,560,000 Section 179 expensing limits before Q3 deadlines Accelerate necessary capital expenditures on information processing equipment or software to completely offset your top-line tax brackets. Step 3. Realign your portfolio and purge terminated clean energy positions. Recognize that the new clean vehicle credit and used clean vehicle credit are dead. Legacy clean energy tax incentives are completely sunsetting. Review your equity holdings and capital allocation in these sectors. The capital flow is aggressively shifting toward domestic manufacturing, industrial metals, and computing infrastructure, which saw a 22% annualized surge in data center investments this year. Align your portfolio with where the federal tax code is actively subsidizing growth. Step 4. For taxpayers 65 and older, deploy a senior tax shield buffer. If you or your spouse are entering or currently within this demographic, construct your income generation systems to intentionally sit below the $150,000 joint income phase-out threshold. This preserves the maximum $6,000 senior bonus standard deduction, effectively creating a tax-free cash flow buffer that maximizes your risk-adjusted net returns. This channel does not give you speculative hype, and we do not participate in financial wishful thinking. We track the capital, analyze the policy, and build data-driven systems to guarantee your long-term wealth building and income diversification. If you want evidence-based financial education that protects your capital from state-sponsored wealth erosion, hit the subscribe button right now, turn on notifications, and execute on this data. Please remember that this content is for educational purposes only and should not be considered financial, investment, tax, or legal advice. Every wealth system requires individualized analysis under the guidance of licensed professionals. Structure your cash flow, protect your capital. No one is going to save your portfolio for you. I'm Jaxx Sterling. I'll see you in the next video.